If you spend enough years in markets, you eventually discover something that embarrasses the ego. The biggest investing mistakes are usually not made because a person was too stupid to understand a balance sheet. They are made because he was too human to manage his own emotions. That is the part beginners almost never believe. They think investing is mainly an intelligence test. Read more reports, learn more ratios, build a better spreadsheet, study the macro backdrop, find a better model. And then, once you have enough information, money will supposedly begin flowing toward you as a reward for effort. It does not work that way. Information matters, reason matters, business quality matters, price matters. But after watching markets for most of my life, I can tell you this. A great many people who know enough to do well still fail because they cannot keep their heads clear when the market begins whispering to their fears, their pride, their impatience, or their envy. That is why I have always thought the real contest in investing is not just against other people. It is against the weaker parts of yourself, against the part that wants to predict the market, against the part that needs immediate reassurance, against the part that wants to look smart, against the part that hates admitting error, against the part that feels left behind when other people appear to be getting rich more quickly, against the part that freezes when the right answer is right in front of it. Those are the enemies that matter, not because the market is cruel, because the market is a place where human weakness gets translated into numbers. I have made mistakes of every kind, some from action, some from inaction, some because I was too cautious, some because I let myself admire the wrong thing, some because I had the right business and the wrong temperament, and if I were trying to tell a younger investor what actually ruins people over time, I would not begin with complicated formulas or exotic products. I would begin with the errors that are common, respectable, repeated, and expensive. The first one is trying to time the market. This mistake survives every generation because it is emotionally irresistible. People look at the world and think, surely I should try to anticipate what happens next. If rates go up, stocks will suffer. If rates go down, stocks will rally. If a recession is coming, I should wait. If inflation is easing, I should buy. If war breaks out, I should get defensive. If a central banker sounds dovish, I should add risk. If he sounds hawkish, I should pull back. That all sounds sensible until you try to live by it. Then you discover the truth. You are trying to predict too many moving parts at once. You are not just predicting the economy. You are predicting how millions of other people will feel about the economy, when they will change their minds, what is already priced in, what is not, and how the whole thing will interact with valuation. That is a terrible game. Ben Graham, whom I admired deeply, occasionally wandered too close to broad market judgments for my taste. Charlie and I never found much advantage there. Not because the market is unimportant. The market is obviously important. But I learned very early to ask a stricter question. Is the thing I am focusing on both important and knowable? The direction of the general market over the next year is important. It is not especially knowable. The exact path of rates is important. It is not especially knowable. What Jerome Powell will do 6 months from now is important. I doubt Jerome Powell himself knows with the certainty television viewers expect from him. That is why I have always preferred to spend my life on what is both important and sufficiently knowable. The future economics of an individual business, its competitive position, its management, the price I am paying. Those things are not perfectly knowable either, but they are much more within reach than pretending I can forecast the entire emotional weather of the stock market. I know people who have made money by understanding businesses. I know very few who have made long-lasting fortunes by correctly calling the market over and over again. A man who keeps trying to buy the dip and sell the top usually ends up doing one of two things. He either stays out too long waiting for a cleaner signal that never really arrives, or he jumps in and out so often that taxes, missed recoveries, and nervous decision, making eat him alive. The market does not reward all effort equally. Some effort is simply wasted motion. This is one of those cases. The second mistake is getting attached to your purchase price. This one has always amused me because it is so plainly irrational and so widely practiced. A stock trades at 50, one person bought at 10 and feels brilliant. Another bought at 100 and feels sick. A third bought at 51 and is already telling himself some emotional story about betrayal. The stock does not care. The business does not care. From today forward, all three investors face the exact same reality. The only thing that matters now is what the business is worth from here. That is it. Not what you paid. Not whether you are ahead. Not whether you are behind. Not whether selling now would allow you to say the whole thing worked out. The future of the decision lives in the future, not in your original entry point. And yet investors cling to purchase prices as if the market were obligated to comfort them. It is not. The market has no empathy. If a business is attractive today, it is attractive today whether you first bought it at 10, 100, or last Thursday. If it is unattractive today, then your private need to get back to even is irrelevant. I have seen investors refuse to sell poor businesses because they could not bear to admit the loss. I have seen others sell superb businesses too early because they were delighted by a gain that was tiny compared with the company's remaining potential. Both are making the same mistake. They are allowing the past to govern a decision that should be made with a blank slate. One of the most expensive versions of this error in my own life showed up in the form of hesitation. I knew Walmart was a remarkable business. I understood what it was doing. I understood the economics. I liked what I saw. But the price moved slightly away from where I first wanted it. And instead of acting like an owner who understood the opportunity, I allowed myself to become attached to the earlier, prettier entry point in my head. That difference cost Berkshire an extraordinary amount of money over time. The market does not know or care what price would have made you happier. It only offers the price it offers. The third mistake is assuming aggressive growth will solve every valuation problem. This one is especially seductive because it begins with a truth. Wonderful businesses can grow. Some of them can grow for a very long time. Charlie taught me that paying more for the right business can be wiser than paying very little for the wrong one. That was one of the most important lessons of my career. But Wall Street being what it is, a good insight rarely stays clean for long. Soon enough, the crowd starts abusing it. Growth becomes a universal excuse. Every rich multiple gets defended with a story about how earnings will soon catch up. Every expensive stock becomes reasonable if only the company keeps compounding at a heroic rate for years and years. That is not analysis. That is hope wearing a tie. Very few large businesses can keep compounding earnings at extraordinary rates for very long. A few can. Most cannot. And the danger is that investors behave as if the exceptional cases are common. They are not. You can pay up for a business and still do very well if the business is unusually strong, unusually durable, and still has a long runway. I have done that, but growth at any price is a trap. A company can be wonderful and still be a poor investment if the expectations embedded in the price are too demanding. When you buy at 20, 30, or 40 times earnings, you are not just saying the business is good. You are saying it will stay excellent for longer and more powerfully than the market currently requires in order for you to earn a decent return. That is a much harder bet than people admit to themselves. The market loves making hard bets feel easy in the late stages of enthusiasm. That is why so many people overpay for the story of growth and then act surprised when the stock gives them mediocre returns, despite the business doing fairly well. The return was already pulled forward. The fourth mistake is leverage. I have said for a long time that the only way a smart person who is reasonably disciplined about investments can truly blow himself up is through leverage. Leverage is the financial equivalent of saying, I may be right, but I am willing to let somebody else decide whether I get enough time to prove it. That is a foolish arrangement. If you borrow heavily, you can be correct in your analysis and still lose, because the path turned against you before the outcome came to your rescue. That is the deep danger. It is not just that leverage magnifies losses, it shortens your timetable. And time is one of the greatest allies a good investor has. The moment you borrow heavily, you invite another party into your life. A lender, a broker, a bank, a margin desk. That party has no interest in your long-term brilliance. He has terms, collateral, and a timetable. If the position moves against you enough, he does not care that you are probably right in the end. He cares that you owe money now. I have seen people short absurd stocks and get carried out on stretchers because the stock remained absurd longer than they could remain solvent. I have seen leveraged owners of seemingly safe assets forced into terrible decisions because they had confused higher returns with strength. During calm periods, leverage flatters intelligence. It makes people look more gifted than they are. During violent periods, it reveals how fragile the structure really was. I would rather own less in sleep than own more, and live on someone else's patience. The fifth mistake is missing the forest for the trees. This is a subtle one because detail matters. You do not want to be lazy. You do not want to wave your way through serious analysis, but investors often lose sight of the fact that not all details matter equally. In a great many business decisions, the largest outcomes are driven by a few critical questions. What are the long-term economics of the business? What are the economics of the industry? Who is running the place? What price am I paying? Those are the big levers. You can spend a month obsessing over some tiny contractual issue, some small technical item, some little patent concern, and still miss the fact that the business itself is structurally weak, the industry is deteriorating, management is poor, or the valuation is absurd. That is what I mean by missing the forest for the trees. Charlie and I were never interested in making things more complicated than they needed to be. We liked easy problems. We preferred 1-foot bars to 7-foot bars. We preferred businesses we could explain clearly to ourselves. I have made mistakes in acquisitions, but the giant ones were never because I overlooked some microscopic detail while the central economic picture was otherwise sound. The giant ones happened because I misjudged the future economics, the real durability or the quality of the leadership. That is where the money is won or lost. A man can know every leaf on every tree and still not know whether he is standing in a healthy forest. The sixth mistake is trying to jump over 7-foot bars. This one offends smart people because it suggests difficulty is not automatically rewarded. In many walks of life, doing the harder thing earns admiration. The more difficult equation, the tougher climb, the more elegant solution, the more complex structure. Investing does not care. You are not paid extra because your investment was harder to understand. You are not handed a larger return because the analysis sounded more sophisticated in a room full of other people trying to impress one another. You are paid for being right. That is all. So why spend your time on impossible forecasts, unclear industries, wildly contingent models, and businesses that require heroic assumptions when easier opportunities exist? Some investors cannot resist the hard problem because it flatters them. It makes them feel special. That is a bad reason to put money at risk. I do not want to be rewarded for solving the hard problem. I want to be rewarded for solving the right one. The market is full of 1-foot bars. Understandable businesses, understandable economics, reasonable valuations, durable advantages. The investor who insists on hunting only in the murky swamps of complexity is often not being brave. He is indulging vanity. The seventh mistake is shrinking your universe of opportunities too much. There is a line between having a circle of competence and building a prison out of your preferences. That line matters. I believe deeply in staying within what you understand. I do not believe in refusing to look at whole categories of opportunity because they do not fit some narrow label you happen to prefer. I have seen people say they only buy one sector, one geography, one style box, one income profile, one niche, one theme. That is not wisdom. That is a self-imposed famine opportunity moves. Sometimes it appears in obvious places. Sometimes it appears in places people think cannot possibly matter. If you shrink your universe too aggressively, you may never even see the thing that could have changed your financial life. At Berkshire, our practical universe narrowed somewhat because of our size. That is natural. But as a principle, Charlie and I never wanted to unnecessarily circumscribe where opportunity might appear. You should know what you know and what you do not know. You should not decide in advance that the market must only reward you through one window. That is a childish way to approach a very large world. The eighth mistake is staying active all the time. This is one of the strangest truths in investing. In most professions, inactivity is a sign of weakness. In investing, inactivity is often a sign of intelligence. Not always. A lazy person can pretend he is patient. That is not what I mean. I mean that the structure of investing gives you a gift almost no other field provides. You do not have to swing at every pitch. You cannot strike out by waiting. You can stand there all day and let the wrong opportunities pass. That is a tremendous advantage. Most people waste it because they equate activity with seriousness. They need to feel in motion. They need to feel involved. They need to be doing something. That is a costly impulse. You cannot buy the equivalent of a Coca-Cola at a fair price every week. You cannot force the market to present you with a fat pitch on your preferred schedule. Sometimes the market is generous. Sometimes it is barren. Sometimes the opportunities are good but outside your competence. Sometimes the best thing you can do for your portfolio is sit still. That is very hard for people whose identity depends on constant movement. But movement is not value. Waiting for the right pitch is one of the highest return habits in the whole field. The ninth mistake is diversifying too much. Now, for the average uninformed investor, broad diversification is a blessing. A low-cost index fund is a far superior answer to random stock picking by someone who neither studies businesses nor wants to. That is not an insult. It is simply honest. But once you become what I would call a know-something investor, someone who actually studies, understands, and ranks businesses, then there comes a point where adding more names does not help. It dilutes. If you really know businesses, you do not need 50 of them. If you can find 6 or 8 truly outstanding opportunities and you understand them, well, the 7th or 9th or 12th idea is often weaker, simply because it is later on your own list. People love to talk about diversification as though more is always safer. Sometimes more is just less conviction with extra paperwork. A lot of people have gotten rich on their best idea. Very few have gotten rich on their 7th best idea. Again, this is not a call for recklessness or amateur concentration. It is a call for honesty. If you know very little, diversify broadly. If you know a lot about a few businesses, do not pretend your extra knowledge was built only to be watered down into mediocrity. The 10th mistake is confirmation bias. Charlie used to say that the human mind is very good at interpreting new information, so that prior conclusions remain intact. That is true. A man buys a stock. Immediately his mind becomes its defense attorney. New evidence appears. He explains it away. Bad news arrives. He minimizes it. A better idea comes along. He says it is not really comparable. He no longer sees the world with a blank slate. He sees the world through the emotional need to remain right. This is one of the most expensive habits in investing, because markets do not care whether your ego survives contact with the facts. I have made major mistakes because I was unwilling to look afresh at something I had already decided. That is not a proud admission. It is a useful one. The cure is deliberate disloyalty to your own conclusions. Ask what could make you wrong. Ask what the bear case is. Ask what you would think if you did not already own the stock. Ask what would make you sell if you were being completely honest. Ownership creates attachment clouds. Judgment is the one thing you absolutely cannot afford to cloud. The 11th mistake is following the herd. In ordinary life, social proof can be helpful. In markets, it becomes dangerous because price is set by people. A stock may be a fine business and still be a poor investment if the whole crowd already agrees on its excellence and has pushed the valuation to absurdity. That is why hearing your friends, your parents, your neighbors, and every person at a dinner table praise the same investment is not usually comforting to me. It is often a warning that the consensus is now inside the price. The market is unique in that what is clear to the broad crowd is very often a poor place to seek future outperformance. And the most dangerous moment of all is when other people are getting rich doing something that looks easy. That is when even disciplined people start rationalizing. They tell themselves the crowd cannot all be wrong. They tell themselves the gains are too obvious to ignore. They tell themselves this time they are merely being open-minded. No, usually they are just arriving late. I have made mistakes because someone else's gains looked easy and tempting. That is how herd behavior works. It wears the face of social proof and sometimes the face of envy. Both are expensive. The 12th mistake, and perhaps the one that has cost me more than any other, is omission. People think the worst investing mistakes come from doing the wrong thing. Some do. But the ones that have haunted me most were the opportunities I understood well enough to act on, opportunities within my circle of competence, opportunities whose logic was strong enough, and I still did nothing. I sat there, I waited, I wanted the terms a little better, I wanted the conditions a little cleaner, I wanted one more sign. That kind of hesitation has cost Berkshire billions. With Fannie Mae years ago, with Walmart, nearly with See's Candies. Those are not little wounds. They are the kinds of mistakes you remember, because the business then goes on compounding magnificently, while you sit there having saved a little on price and lost a fortune in outcome. Omission often grows out of the same emotional weaknesses as the other errors. Purchase. Price anchoring a desire for perfection. Fear of looking foolish if the stock falls after you buy it. A little too much caution disguised as discipline. A great investment life needs patience, yes. But it also needs courage, the courage to take a full bite when something within your competence is clearly attractive. Not to nibble, not to watch, not to tell yourself you can always come back later. Later is often more expensive. If I step back from these 12 errors, I see one larger pattern beneath them all. The investor keeps being invited to abandon his proper role. His proper role is simple enough. Understand businesses, pay sensible prices, stay inside what you can know. Avoid leverage, ignore the crowd when it deserves ignoring, wait for the fat pitch, and act decisively when it arrives. That is the role. The market wants you to become something else. A predictor, a trader, a macro prophet, a borrower, a complexity addict, a narrow ideologue, a compulsive diversifier, a defender of your own past decisions, a member of the herd, or a frightened thumb. Sucker when real opportunity appears. That is the real contest. Not just whether you can analyze a business, whether you can resist becoming the wrong kind of person while you invest. The market does not reward intelligence alone. It rewards temperament, it rewards discipline, it rewards simplicity, it rewards the person who can remain rational while others become emotional. That is why Charlie mattered so much to me. Charlie had a gift for stripping nonsense of its social prestige. He could look at something complicated and ask whether it was really worth the extra effort. He could look at something popular and ask whether the price already reflected all the comfort the crowd was taking from it. He could look at my own hesitation and tell me plainly when I was being silly. That kind of thinking is priceless, because investing is full of situations where the elegant, sounding answer is the expensive one. The dull, sounding answer is often much richer. I would much rather be boring and wealthy than exciting and fragile. That has always seemed to me a fair trade. If I were speaking to a young investor today, I would not first ask what stocks he likes. I would ask what weaknesses he carries into the market. Does he need action to feel intelligent? Does he become envious when others get rich quickly? Does he cling to entry prices? Does he defend his choices too stubbornly? Does he overestimate his forecasting ability? Does he fear concentration because he has never really learned to rank his own ideas honestly? Does he freeze when the case is good because he wants the price to be a little prettier? Those are the questions that matter, because the market will eventually discover every weakness you leave unguarded. That is what it does. If you know your weakness early, you can design around it. You can automate. You can reduce leverage to zero. You can stop checking prices constantly. You can force yourself to write the bear case before buying. You can rank your ideas honestly. You can practice doing nothing. You can build the habit of looking at every position from a blank slate. And over time, those habits become a kind of armor, not perfect armor. Nothing in markets is perfect, but enough armor that you stop injuring yourself in the same cheap ways over and over again. That alone puts you far ahead of most investors. Far enough ahead that, after decades, the result can look mysterious from the outside. It is not mysterious. It is simply the arithmetic of fewer self-inflicted wounds. And in investing, that is already a very large advantage.